ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Now, the issue of market asymmetry was introduced more in the before it came to strategy, before it came to competitiveness, strategic competitiveness. It was more in the financial markets. You know, with the financial markets, we talk about capital markets, money market, stock market, and so forth, because the information is very important. If people have the information, there's a decision they can make, without which they cannot make. Therefore, you find that presence of information or lack of it determines a lot about the decision investors make, the decision managers make, and basically, you know, the strategy that they are going to deploy to attain a competitive advantage. Now I'm sharing my screen. I hope you are seeing it. I'm sharing my screen. Okay. Can you see my screen, please?
Yes.
Screen? Is it okay?
Yes,
Is
yes.
there any blockage maybe?
Yes. Yes.
Is there any blockage or is it clear?
Yes.
Any blockage? Is it clear?
It's clear.
It's clear? All right. Yes. So what I was explaining is that
Yes.
information is key. You know, information is very key because strategic selection and most other business decisions are basically process. Most other business activities are decision processes. Therefore, the decision you make, the strategy you choose, how you implement it, the expected performance is more related to the information you have or lack of it. Now, in pure competitive markets, you expect information to be available equally to every player, right? But in markets that are not perfect, that are called imperfect markets, then you expect information asymmetry. That is, to some extent, some information is held by some players, but some other players do not have it. And that is now what brings information asymmetry. There is lack of information for some groups and little or less information for the others. For example, when you go for medical services, you go for the insurance sector, you go for the car industry, you find that there's a lot of information with sellers or the providers of the services or products that the customers, the buyers may not have, or they may have a half of it, or just a bit of it. For example, in terms of performance of cars, the sellers normally know. They normally know how the cars perform. If today you are to buy, I think the case we had is about It's about, was it about Toyota or Volkswagen? Volkswagen. But if we could give an example of Toyota, maybe you have different brands of Toyota. The seller knows how this performs. The buyer may not know. If you compare Toyota Vitz, Toyota Leon, Toyota Premio, I hope these cars are in the streets in Addis. I think I've seen some of them. You also have Toyota RAV4, Toyota Harrier. You know, there are information that the car sellers may have that the buyers may not have. And that is what now brings information asymmetry. Now, I'm not really sure, but one of the secrets that is there, they will tell you that the engine for the Toyota Premio is the same engine for the RAV4, right? This information with mostly sellers. Buyers may not know, especially if you are a new car buyer. If you've been in the car industry for long, you'll understand. But if you just new, you may not know. But you find that despite the engine being the same, the body is different. And sometimes you find there are 4 cells even twice the premium. Now, that's information that is held by the manufacturers, by the sellers. That the manufacturers may give you all this information because they don't have any hidden agenda in the business, because all cars belong to them. But the sellers, when you go to the sellers, they may not disclose this. Why? They may use this information for their benefit. And this is what now brings information asymmetry. Now, in such a situation, we say that if you have a decision to make between 2 items, the one last the product or the service looks better off is normally called peach in industry, in strategy. The one that looks on the lower side is called a lemon. Of course, you know peaches are very sweet. And they may also cost a lot more than the lemons. But what you don't know is that if you buy a lemon and you put 1 teaspoonful of sugar, if you remove the juice from the pulp, then you put 1 teaspoonful of sugar, maybe it will still taste as a lemon. And maybe all the other ingredients may be the same, or even the lemon may have more health benefits than the peach. But that's how it is. Now, if you have a peach and a lemon in the market, probability of selling each is 0.5. That's a half. But now the challenge comes. There may be some information about the peach that the seller doesn't have. If he has that information, the probability changes. If on the other side he has information about the lemons, then the probability changes. So the same with strategies. If you have 2 strategies you need to implement, you need to check what are the implications of this and what information do you have about that strategy and so forth. So now we said that a doctor knows more about medical services than the buyer, right? That's why you find you go see the doctor, he may charge you different for the same service. 2 people come, Shimeles comes now for a medical procedure, he's paid, charges $2. Someone comes after 2 minutes, he's charged $4, right? Because maybe Shimeles may have information that someone does not have, and therefore firms use this information to derive competitive advantage. You know, for the medical practitioner, you make sure that if he gets 10 people like Shimeles, he gets the same money, he treats like 3 people from somewhere. So he has to choose, right? He either, if it's maybe some kind of a middle, in a middle income estate, he may go for both. But if it's an high-end estate, he may decide to deal with the big clients only. And that derives competitive advantage, looking in the future. The same with the insurance. I think one of your colleagues says in the insurance we were discussing the other day. Risk, the risk that patients face. Maybe older people are more likely to face, the probability of the risk is higher than more young people. The health of the people who smoke are more likely to have a bad health than people who don't smoke. People who exercise, physical exercise, are more likely to be more healthy, and therefore they are more likely to be less prone to diseases as compared to people who don't exercise. People who eat healthy, who eat a balanced diet, eat a lot of roughage and less proteins and less meat and so forth, carnivorous, they are more likely to have a better health, and of course holding all the other factors constant. And therefore the insurance uses this to be able to manage those customers. Based on the fact that some may have information, others may not have. But in the event that that information might be missing, then there's what we call grading, there's what we call sorting. You may find that health insurance becomes expensive both for the healthy and the unhealthy, right? If you reverse the roles, the insurance seller may not have all the information about the healthy and unhealthy people. So what happens? He makes sure that he charges high price for every customer because he doesn't know who has a terminal illness and who doesn't have a terminal illness. And therefore that means the society pays high prices for that. In a normal setup, we expect high premiums for the people who are more prone and less premiums for people who are less prone to the probability of an event happening. It's like what I was explaining, the lemons and the oranges, the peach and the lemons, Second car owner knows more about the car than the potential buyer. He knows how it performs. He also knows the value of that car, right? And that's why buyers need to dig a lot of information before they make a decision to buy or whatever it is. Now, this what we introduced the other time, we are talking about the paradox, alcohols, lemon and oranges, because it has implications in business. The idea is that the quality of a good, the quality, the price, whatever you call it, is not very much distinguishable by looking at it, right? You cannot tell how a car looks like by looking at it. You cannot know how a strategy looks like by just looking at it with normal eyes, right? Because there's a lot of lack of information or information about that car, about that strategy, about that lemon, about that peach. And therefore, as I was explaining the issue of the insurance, if such information is not very clear, then you make an average decision. That's why before you buy a car, you go and ask people, how much does this cost? Or you go to several shops. Ask shop number 1, how much does this particular car cost? Go to shop number 2, go to shop number 3. You're trying to, to limit the information asymmetry by getting more information about that, Because at the end of the day, if you don't do that, you may end up not getting a good deal. And that is not your obligation. Your obligation or your desire is to get the best deal. So Alcalif said that if there are cases of peaches and lemons in the market and information is not readily available, then the bad products, in quotes, the lemons, will chase away the peaches in the market. Why? In most cases, if the information is lacking, the seller may earn more from the lemons than from the peach, right? because the prices for pitch is not highly negotiable. The prices for new cars, for example, is not very highly negotiable. It rotates within a very small margin because of the value of the car, right? But the price of a lemon can escalate if information is not available. For your information, there are people who buy second-hand cars, the price of a new car, because they don't know. Especially if you get brokers in the market, they can sell you anything, right? And this is now the case that was advocated by Acolif and other scholars. So we are saying that if the products of low quality will be increasingly sold in the market, since the sellers get more value from those second-hand products, and the buyers are not aware, then that means that the lemons will kick away all the peaches in the market, and customers will be getting a raw deal. But the sellers will be enjoying the whole loot, and that's the issue about information asymmetry. The same to strategies. If you're employing strategies, you have to get all the necessary information about that strategy. That's why we do analysis and choice. If there is missing information about a particular strategy, for example, if you talk about pricing strategy, what you may not know is that the moment you start playing with the price, your competitors may also play with their price, right? And at the end of the day, you may not win that war, especially if your competitor has many resources than you have. I think we've talked about this before. So information asymmetry is what I was explaining, is a situation whereby information is insufficient, and if information is insufficient, it may lead to what is called market failure. Because the party with superior information might strategically select to either participate or abstain from a given market. In this case, from choosing a certain strategy. And therefore, information asymmetry generates two types of outcomes. One is what we call adverse selection. The other one is called moral hazard. So adverse selection is the first case. This happens when there's maybe two or more people enter into an agreement, and one of them happens to have information that the other do not have. That means one may have a competitive advantage over there. And that is the market for lemon that was written by George Acolif that I was explaining out there. If information is not available, then the bad products will kick out the good products in the market. So that means then, if you're a producer of a product, it may be high quality. If your consumers don't have the right information, if your customers don't have the right information, the poor products will kick your product out of the market. That's basically what it means, right? And therefore, what does it mean to people in strategic management? It means that information must be made available, both up the vertical chain and down the vertical chain, right? Because information is very important for the decision making, right? Because when you buy a used car, as I was explaining, the potential buyer of a used car may not easily ascertain the true value of that car because he lacks that information. And if this continues, then you may find that the market for second-hand cars may flourish. And if it flourishes, it drives the more valuable cars, which are the pitches, out of the market. And of course, Africa, for example, has been a dumping site in quartz of second-hand cars from from across the oceans. I don't want to mention any country per se. Of course, they say this is what we can afford, but is it really the case? Because when you go out there in these foreign countries, how much does a new car per se cost? And how much does a used car, used there, but here new car? When it comes here, it is used, but here it becomes a new car. Into what? How much does it cost? You may find that there's a difference, but the difference benefits the sellers, the brokers, because of market asymmetry, because of market lack of or available of market information to some people and not the others, you know. So as I explained, this is a case whereby I explained the case of the insurance selection. They have a tendency to put a big premium for the high risky lifestyles or jobs. But for the other people, the premium is low. For example, if you are working in a construction site, in a mining site, and you are dealing with explosives and dangerous minerals and chemicals, you are more likely to ascertain a high premium for your life insurance than a normal person who works in a bank or in another person. So I think you can study much about that. Now, how do you deal with the problem of adverse selection? You use signaling, you use grading and so forth, because adverse selection is an outcome of information deficiency, which you are calling asymmetry. Then you can improve, you know, you can improve the information and therefore improve the decision the person makes by signaling, by providing credibility to your claims, either through warranties. So you go, you buy a mobile phone, they tell you a warranty for 1 year, 2 months, references, you know, and so forth. These are ways of improving the information in the market, you know, and making, you know, to deal away or to minimize the effects of adverse selection. This is the case I was explaining. If there are lemons in the shop, let's say second-hand car or used cars, maybe the expected value from the seller is $1,000 or whatever bid, whatever you call it. But the buyer is willing to pay $1,200. If there's no signaling, that means there's no a lot of information in it, then it can go for that amount or nearest offer. It can go even up to $1,500, sometimes even to $2,000. If the information is there, is not there. The same for a pitch. That's a new car, a new product, or a new strategy, or a better strategy for that matter. If the value is $2,000, that is expected from the seller. Of course, the seller must sell with some margin. Maybe makes a margin of 400 or something. That becomes 2,400. Without signaling, then more people may buy the lemons. And therefore, the lemons will kick away the pitch from the market, right? Because the buyers don't have that information. They don't have a lot of information. In fact, I explained that sometimes they can even, the lemons can buy, they can sell for the same amount, even up to 2,000, because the information is there. But when there is signaling, then it changes, you know. Maybe if it is a lemon, you know, if people have the information, they may not buy. You may only buy the new cars only. And therefore, the sellers, in this case, the managers of farms, should use this information for competitive purposes to be able to assist in deriving competitive advantage for the farm. If you are the manager for the lemon, then you look at ways of how you can add value to your product to be competitive. If you are the manager for the peach, you do the same. You see how you can add value to your product. If you're a manager of a farm that sells both, then you need to see how you can add value to the lemon, add value to the peach, right? And avoid the adverse selection. Because again, customers buy and come and buy again. If a customer makes a choice through adverse selection and makes a choice that may not be the best, and he gets information later, that customer will never come to your shop again to buy a car. So I said you can study much about this. A lot of literature about market signaling and quality and how this happens. I think that literature there you can study much. There's also what we call grading and sorting. For the case of the insurance people, they classify people in terms of age. The aged, they are more likely to be sick. Therefore, in their medical cover, you may find more money. The young ones, maybe, then people in the middle, depending, of course, on other things. And then ethnicity, although it's not the best thing, but that's what happens. We also have issues of gender. We also have issues of wealth. That's what we have what you call price discrimination that works on imperfect market. Otherwise, if the market is perfect, then price discrimination may not work, because the rich will pay high for the same product, the poor will pay less or medium for the same product, and so forth. Maybe what are the challenges to adverse selection? Of course, now, in practice, adverse selection may not work if information triggers as the person is trying to make the decision. Again, if the information is lacking, the adverse selection will go to the full. But if information comes bit by bit, it may trigger, it may change the decision that the buyers make. But more importantly, sometimes markets cannot be able to differentiate between various types of consumers. Therefore, this brings more asymmetry into the asymmetric information. Plus also other issues about compensation. There's compensation that happens like in insurance. I think we'll see this under the moral hazard. Maybe there are regulations that are imposed, then they may affect negatively the adverse selection principle. So now the second issue about information asymmetry is the moral hazard. And this is a situation, remember the first one was adverse selection, it's moral hazard. This is a situation in which information asymmetry occurs after an agreement between the parties. Remember, adverse selection is before the decision is made, but moral hazard is after the decision has been made. You've already made the purchase, you bought insurance, maybe you've protected you've get a cover, a policy for your house against fire, right? Against fire. So you are very sure that if the fire burns down your house, you'll be compensated by the insurance company. So you become reckless because you've already pushed the risk to the insurance company. Reckless in quotes. You are not very much concerned about safety and fire protection in your house because the house is insured. You insure your health, that is life assurance, but you don't care what you eat or what you drink or what you smoke, because you know in the event of a death, insurance will pay. And this is called moral hazard because it happens after the decision has been made. That means if people may eat unhealthy food, they may drink a lot, they may take a lot of cigarettes and so forth, things that may not be good for the health. But it's because they are insured. They don't care. That's why it is called a moral hazard. It's an hazard, but it is based on the morality of the person. Maybe not And because of this, then there becomes the agency problem. We talked about corporate governance, and you saw, I think my internet is trying to misbehave again. I hope it doesn't go off like the other time. So what does that mean? It means that if this asymmetry continues, then moral hazard happens, right? It means, you know, the agent and the principal each has some duties to perform, obligations. But if one is not performing his obligation, then we talk about the moral hazard happening. So we said this is the second case. Because the risk has been distributed from the insured to the insurer, then the insured becomes less careful. You insured your health, but because you already have the cover, then you become a little bit careless. You insure your car, and because it's insured, you don't service it well, you don't take good care of it, because, you know, if you get an accident, you'll be paid, you'll be compensated. It goes to some extent. The extreme part of the moral hazard is whereby you initiate the risk so that you can be compensated. That's criminal. You've seen some people insuring the house, then removing everything at night, and then setting the house on fire. That's criminal, but it's also still part of the moral hazard. Of course, if the insurance come and realizes this, then they are not going to compensate you, because they compensate based on the policy that you bought, which is supposed to be natural risk. The cost which is natural and not any risk that is bound to be caused by negligence or by ill intent. And therefore, this is now what makes the agency, the principal agency problem to skyrocket. Because it means if people are not careful with what they have insured, then the insurance companies are going to be paying more claims for events that would have been prevented. Then that means if the insurance company, you know how the insurance works. It's about pooling the risk. Then out of maybe 100 risks that have been covered, maybe 20% will come to pass. Then you use money from the other collection to pay that. Otherwise, if everybody who was insured gets, or the event happens, then the insurance company will not be able to pay. It will run bankrupt. I hope you understand very much how the insurance company operates. So it is based on probability and pooling of resources together to be able to compensate. Remember, the policy, the premiums you pay are just a little part of the total value of the insured property or asset. For example, if you have your car valued at 2 million, right? You may pay up to 20%, 10%, you know, even that is high, maybe comprehensive. 4% of the value of the vehicle. 4% is very tiny. But we expect out of 100 cases, maybe 10% will come to pass. 90% will not happen. And therefore, the insurance company uses that money to compensate the others and also run their business and so forth. And therefore, that is how moral hazard is initiated. But if the moral hazard continues, it is dangerous for the economy. It's dangerous for business, because it means if the firm continues to give more claims, then it means the firm may end up increasing the premiums to continue covering its risky business and so forth. I think that's what I was explaining about the moral hazard, and that depends on how the risk behaves. So why does the moral hazard occur? Of course, it occurs because there's a cost that is involved in taking care of safety. There's a cost that is involved in making sure that your car is stable, you don't make a lot of accidents on the road. Servicing it is costly. Making sure it is in good condition, right? So people who do not want to spend this money, they may lead to moral hazard, right? Of course, the cost of to life insurance, the cost of making yourself healthy, eating healthy, staying healthy, is also a cost that the insured may fail to uphold. So that cost, you know, of making sure that the precautions to avoid the particular loss that has been insured are incurred is what most people may fail to. And that is what leads to a moral hazard. How can you reduce it, or how can you prevent it? Using what is called deductibles. I think especially the people in the insurance, they know this, that you must pay initial up to some limits, right? And then you also what you call co-payments. This is whereby you pay you pay a percentage of the bills. So that means it may not be full of it. So that minimizes moral hazard from there, because the insured may not necessarily get the full amount. Same to when you've underinsured, or when you have overinsured, because that also can lead to moral hazard. When your car is worth 5 million, but when you're insuring, you declare 7 million. In the event of a loss, the insurance will pay you 7 million, and therefore the principles of insurance will fail, because insurance is supposed to make sure that you are compensated back to your position. But in this case, if that does not happen, you'll be paid 7 million, yet your car is 5 million. Therefore, you are going to benefit. In a way, you'll have benefited from the insurance company. That is a failure in the market that should be discouraged to avoid, to avoid people benefiting out of that. Remember, the insurance is supposed to take you back to your financial situation and not benefit in any way from it. So how can you deal with market failure? I think these are just a few of them. Awareness campaigns, that's why we talked about the issue of information. If information is not available, very much of it, then you need to make sure that that information is availed by several people. Of course, the government is involved, because the government controls all the businesses that take place in an organization or in a business, wherever it is. So campaigns, compulsory labeling of foods. This food is dangerous, cigarettes is dangerous, and so forth. Compulsory health screening, like the case for cancer. Now we have COVID and so forth. Compulsory pension savings, so that people, the old, once they retire from business, they'll not be exploited by the insurance people, right? Because if they don't insure, if they don't have a good pension scheme, then when they are going to insure themselves, then it will be expensive, and that kind of idea. Maybe it asks for discussion, and this is for you now. How is your understanding of moral hazard and adverse selection? How do you understand it, and how does it apply in strategy? Explain the case of information asymmetry in choosing in between competitive strategies. In what ways does moral hazard affect strategy performance, strategy selection, implementation, and performance? This is for your discussion. I don't know who is online. Maybe you can have a small discussion as I fix my tools here. Who is online? Anybody who can explain the case of information asymmetry in choosing between competitive strategies? Who is online, please? Yes, Samuel, I think your hand is up.
Okay,
Samuel.
Thank you, Doctor. Yeah. Okay. When you were talking about the information asymmetry, what came to my mind was the way things work here in Ethiopia, especially a market which we say is led by the Dalala. brokers. Like whenever they say something about any product or anything in the market, the whole market is kind of led by that kind of information. For instance, a car which is worth maybe 300,000 in local currency might even go up to 4,000 or even more just because of the information given by those brokers. So I think when you talk of the information asymmetry, to me it meant like the gap or the missing of the right information between the buyer and seller. Especially in the case of Ethiopia, I think it comes through the brokers. So in this case, I think we can understand the information which we might have, or if we might not have, but the same information might lack between the buyer and seller, or those who sell or buy. That's how I understood the information asymmetry.
Yeah, that's true. That's true. That's the basis of information asymmetry. Yes, very common, especially where the case of cars are very, very common. And that's why we said now that information asymmetry can be sorted by awareness, for example, right? We have, so in some countries, we have what we call consumer awareness programs, headed by organizations that we have Consumer Insight, Consumer Watch, and so forth. They can be able to clear or to finish this information asymmetry. But of course, now it is to the detriment of the buyers, who are now the brokers. That's why you find, as you explained, you can go to one shop, you find this guy is selling this. You go to another shop, this guy is selling at a different case. Now, the worst case when it comes to information asymmetry is whereby if you have brokers, you still maintain the issue of the car. You have a car in the yard that is for sale. Maybe you've given out your car for sale. And there are several brokers that are selling that car, right? Now, you may find that one person may come to buy that car, but he gets different prices from different brokers. The different brokers may not know that the customer had already viewed the car and is interested. The same to houses. You know, a house somewhere in Ball, it's on sale. Then it says, call this number. You call this number, the number is for a broker. Let's say broker A, right? Broker A gives the houses like that. He gives the information, this. But of course, he makes sure that he doesn't give you all the information because you don't have all the information. Then he gives you, because the house is like this is the price. Then you'll be shocked. You go to another website or another agent who sells houses. You find the same house listed for sale. Because when the owner wants to sell, does not exactly need to know who sells. As long as it's an agreement, of course, the broker will earn some interest. So you go to the other broker and he gives a complete different information about this. He may tell you the house or the car is 5 years old. The other one tells you the car is only 3 years old. He may tell you, the other one tells you the car is a lady-owned. You know, lady-owned cars are better than the men-owned, in quotes, of course, because ladies don't tend to be very rough drivers like the men. So in the streets there, when you're buying a car, second-hand car, driven by a lady, you are more likely to get a better deal than, of course, not all instances, but on average. So they may tell you this car has been a lady owned for the last 5 years. The other one, he may tell you this car is 5 years, but it's the same product. That means there's information asymmetry. Now, if there is signaling, if signaling comes in, there is awareness, for example, there is a way you can establish the age of a car, but most people may not know. Is it by simply going to the car, interacting with the car, looking at where the details are inscribed in the safety belts and in some movable parts of the car, you will see the car is manufactured on this year. But most people, most buyers may not have this information. If you want to know whether the car was a lady owned, you go and do what is called a search from the government authorities. They'll tell you where the car originated and who was the owner. Maybe if you get the name, it will lead you to know whether the owner was a lady or a man, the owner of the car. But now the other problem is, if the owner in the logbook is a lady, but the lady bought the car for his boyfriend or his husband, now that brings other issues. And all this is what now brings what? The issue of information asymmetry. Well done. Another person who can comment something out of that? Another person with hands up, maybe? No other. So you can continue with this discussion on your own. Okay.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
You can continue the discussion on your own about how does now strategy come in. Of course, I explained briefly about this. So you need to make sure that you choose the best strategy based on what you are facing. In what ways does moral hazard affect strategy? Yes, we've explained the issue of moral hazard. For example, when you are doing pricing, the one we talked about, the insurance, either you decide, get the information, codify the clients, code them, classify them, audit them, or maybe come up with a blanket premium. Now, if you come up with a blanket premium, it means the less prone will pay high. The more prone have no problem, they will pay that. So you may derive away competitiveness out of your farm because of that. Because if you have other farms in the industry that are offering less premiums for the same risk, hoping that the consumers are price sensitive, then you may lose those customers. And that is the issue about information asymmetry. So let me see any question before we move on to something else. Let me see if there's any chat here. I can address them before we go on alone. Yes. Yes, Samuel, as I go through this. Yes, Samuel. Go ahead.
I think it's a kind of a question like about the moral hazard. We were discussing that moral hazard comes after the thing happens or after the purchase happens. Especially you mentioned of the insurance companies. I had in mind of two issues. One is like a car is insured, and then with the combination of somebody, an insider who works in the insurance company that works in collaboration with the car owner, who allows it or who hides information that the car might have been set on fire by the owner itself. That's one issue. And second, maybe even before the car is insured and an estimate is being done at how much the car would cost. Normally here in Ethiopia, it's not like the insurance company sees how much you have bought the car or something like that. You just say, can you insure this car for this kind of an amount? And that's it. So how do you relate these two with the moral hazard? Does it go with it, or how can we explain this one?
Oh, yes, sure. Now, let's stick with the car. Now, normally under insurance provision, now one of the principles of insurance is indemnity. Okay, let's not go deeper into the insurance itself and the way it operates. But normally what that means is that once you've insured something, you insured a car, in the event of the loss, you are supposed to be given back the value of your car, not more, because insurance is not profit making, right? So now, some people, some clients, as I explained, they can overvalue a car. It may happen. Sometimes you may call your insurance officers to come and value your car, and they can be compromised. They can be compromised by the owner of the car. Maybe sell, say, some kickback. This car is worth 3 million. Please quote 3.5 million, right? If the person is compromised. Or you send a person who is not qualified enough to do the valuation. It happens, right? It happens, and that is now where the problem comes. Some other unscrupulous businessmen, as I was saying, they may insure the warehouse or the hardware or the farm, something like fire. It happens. That's why I said it is criminal. And then what happens is that at night they come and remove everything, right? Once they have removed everything, they put the empty godown on fire, right? Then the following day they come to inspect and, you know, claim for payment, you know, to make the claim now. It may not be very easy to establish what was inside the warehouse before the fire. Although in the policy it says that we're insuring this farm for this much, so the value of this godown should be this much, right? The value of the godown should be this much. But once the fire has burned everything, it may not be very, very much possible to establish the value of the godown before the fire. Some unscrupulous businessmen have been accused of this, right? They insure against fire or theft. They come, they remove everything at night, then they declare what? Theft, right? The same to some bank managers, what they do. You know, they know the bank is insured against theft, right? So in the evening when they are closing down, they carry all the money with their bags. They go home. They just leave a few coins there. Then at night, they liaise with thugs to come and break the bank. If the thugs break the bank, what do they go home with? If it was 100 million, the manager went with 80 million, he only left 20 million there. The thugs will go with the 20 million. And that becomes a moral hazard. Because the bank manager knows that the bank is insured. And because it is insured, who benefits in a moral hazard case and is more likely to benefit? The person who is not the intended owner. The same case with the moral hazard. Thugs come to the bank, they shout at you, bring all the money, you know, but the money is insured and the money is not yours. The thugs will tell you, this money is not yours, my friend. Samuel, this is not your money. This money belongs to the bank and it is insured. Because even the thugs know. So they tell you, bring everything. Right? So that may cause what? Because remember, the bank manager is an agent of the shareholders. And that brings agency problem. That's a moral hazard. Because maybe the bank manager did not put all the necessary steps to make sure that the bank is safe, because the bank is insured. The same, they also tell their staff when you are being recruited in the bank, they tell you all the money is insured, your life is more valuable, which is all right. But if the thugs come, you don't raise the alarm because you've been told your life is more precious, which is the case, of course. You cannot compare the life of the people in the bank, the cashiers and everybody, with the money. Life cannot be substituted for money, whichever how much it is. So the thugs come in, the money is insured, so you don't raise the alarm, you don't call the police. That becomes a moral hazard. And it becomes an agent principal problem. Am I clear?
Yeah, it's very clear, very clear.
Okay, good. Jerusalem.
Thank you, Doctor. I have one question to ask. As you know, many economic transactions are made in situations of imperfect information, whether either the buyer, the seller, or both are less than 100% certain about the quality of what is being bought and sold. So also, the transaction may be characterized by asymmetric information. So, can you give me some, differentiations between asymmetric information and imperfect information?
Yes. Yes. Imperfect information is still part of asymmetry. You know, asymmetry means lack of or distorted. It's still part of it. If complete information has been declared, that is symmetrical. That is symmetry, right? But asymmetrical is lack of or distorted information. For example, the case I was explaining, the car. The broker tells you this car has been owned by a man. They may not tell you that, but they'll tell you this car was owned by a lady. But what you may not know is that the car was bought by a lady, but the driver has been the husband, right? But the broker knows that. So he gives you misleading, distorted information for his benefit, right? The other thing he may tell you, this car is only 5 years old. If you don't know how to check out the car, that is misleading and false information. It's part of this incomplete information, so that he can be able to benefit out of that engagement. So it's all incomplete, because what is the point here? The point is that it brings market failure, right? Half information, distorted information, lack of information brings market failure. And what is market failure? It's the fall of demand and supply. Because demand and supply, holding all the other factors, is supposed to guide the market, right? The price of a car, the price of that car we are talking about, maybe it's 300,000 shillings. That is the price, that's a value. So if the market was operating perfectly, the price should not be very far from there. Maybe 301, 299 there, you are okay. The value is okay. But if there is market failure, there is distorted information, there is misrepresentation of information, the car can sell for 600. And that leads to market failure. Okay, fine. Let's go to something else. Okay, yes, Konji. Konji, your hand is up. Konji?
Yeah. Sorry, sir.
Yes.
Can you give us an example if there is any in bargaining markets, in a market where there is a bargaining, can we expect symmetric information?
In a market where there is no bargaining, can you expect information asymmetry? I'm not getting it. In a market there is no bargaining. Market that has fixed prices. Now, in a market that has fixed prices, then it means information asymmetry will not work because the prices are fixed. So whether you have the information or you don't have the information, it's either you buy or you go. That's more of a monopoly. It's a monopoly market, but the prices are fixed. But in a perfect market, even if the prices are fixed, but you can look at the oil industry, for example. The other time you are talking about oil. You know, I don't easily forget things. Now you're talking about oil industry. What do you call oil marketing? You have several players in the industry, but they are all marketers. They don't manufacture the oil, they don't refine. The product is homogeneous, it is the same. Where there is government control, you expect the prices to be the same. So there is no bargaining. You can't go to a fuel station or a petrol station and bargain fuel for your car. The prices are put there. It's fixed. It's fixed. Right? So if the product is homogeneous, product is the same, and the prices are fixed, then maybe misrepresentation can be there. Misrepresentation and false information. Right? Because they tell you oil from Total. Do you have Total in Ethiopia? Jerusalem? Do you have?
Yes.
You have a company called Total? Yes.
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 Do you have a company called BP? BP share?
YBP.
You have.
You have similar YBP.
Yes, they'll tell you oil from this is better for your engine. But why? They don't manufacture oil, do they? They don't. Right? The oil comes from the refinery. The oil is the same, but they tell you the one in blue cylinder or blue container, the other one is in a red container. The oil might be scientifically, chemically, it's all the same. The prices may be the same, but they tell you when you come here, we do service for free. We only sell the oil. If you come here, we check your car. We check the engine oil. We check water. We check brake pads for free. Right? But literally, if the prices are fixed, then imperfection tries to be minimal. Imperfection ceases, it goes down as that happens. I think I'm clear. All right. Now, okay, I need to go to yes. That's okay. Okay.
Yes,
So
thank you.
Okay, welcome. I need to go to the second part of our discussion today. Okay. I'm sharing my screen there. Please confirm that you're seeing what is there. Somebody
Capital
confirm.
markets is clear.
So yeah, it's capital markets. I think
Clear.
it will be our last discussion in chapter 3 as per the timetable. So again, capital markets are very important. The other time we talked about financing. Therefore, I think the vision should have mixed together, should have been pulled together instead of being separate. But capital markets, and basically if you talk about financial markets, are very important in strategic management, as we saw the other time. Because this is whereby you raise the funds. The funds are very, very important. And for for a corporate manager, financing is one of the key functions. The sources of capital, where you get it, and the decisions that you make. Again, in these capital markets, information is also very important. If there's information asymmetry, then you may end up making the wrong decision. You need to make the right decision because financing of the business is key. If you get very expensive loans or very expensive sources of capital because you don't have the right information, it's a loss to the firm. But basically, when you're talking about financial markets, you are looking at institutions where you can be able to mobilize, capital for starting the business, running the business, and so forth. Because all the business activities will need this money. You need banks, you need investment banks, you need money banks, capital banks, finance banks, and you need the financial assets, and so this. So the financial markets, we are talking about the forex market, the capital market, the money market, credit market, derivative market. We are more concerned about the capital market for this case. Maybe in your own ways, you can go to the rest and see what these are. Of course, the money market is whereby borrowers and lenders exchange short-term funds to solve their liquidity needs. It's a money market. The capital market is for the direct, those are the direct or indirect claims to capital. And this is now where corporate managers fall, because corporate financing is part of corporate strategy. Where you borrow, how you borrow it, how much you pay interest is important for the success of the firm. Of course, we have the security market. This whereby where you sell the securities. We have both the primary and the market, primary and secondary market, whereby you can sell shares and so forth. So capital market, very important. This way, investment instruments like bonds, shares, what are traded, right? Especially if the firm needs funds. The capital market is not for everybody. It's for the person, for the organization that needs the money. If you have enough retained earnings, you have enough money from your suppliers, not suppliers, but from your shareholders, you may not need to go and buy. You may not need to go and borrow. So this is purely for firms, who have shortage. And of course, for firms who have surplus. Because the firms that have surplus, they offer their capital. The ones that have a deficit, they go for it. It's just like the way the banks operate. The banks may not have necessarily their own money. They use the money from the customers. The customers who have a lot of money, they deposit and don't need it for the short term. Especially if it is they don't need it for the short term, they put fixed deposits. Those who need the money come and borrow, but the money belongs to the depositors. So that's a market where the buyers and the sellers meet, but they can be able to exchange. What is the role of the Capital Markets Authority for the investors? You get money, for your investment. You also convert what we call liquidity. You can easily convert your investments to the capital markets. It's also good for information dissemination. What about the industry? It's also finance. The company is also finance, right? It's a way to raise the funds from the loans, the loans that you get from the monies that you get to run the business. Maybe to the economy, yeah, it's a market. Therefore, a market is good for the economy. Mobilization of savings, very important. Capital formation. Remember, entrepreneurship is a capital formation process from the firms. Allocation of resources, and then collection of information. As we're talking about information asymmetry and so forth. That's a more increased, not increased, but more reasons for capital markets, pull resources together. So the problem of shortage of funds, mobilize savings, link savers and investors, very, very important. That's why it's a market. Make sure the prices are stable, economic growth, capital formation, liquidity. I think you've seen that, And of course, in there, we have what we call long-term securities. We have what we call trade-offs. Just I think on your own, you can study much about that. It helps in capital formation, liquidity. I think you've seen that. Who are the players? Of course, we've already seen the government. They are the investors, the companies or industries. The investors are usually individuals or groups of individuals who get money here, who buy or invest, surplus fund. We also have companies or industries who seek either they dispose of what they have or they want to get what they don't have. Then, of course, you have the economy. The economy runs on capital markets. So, of course, the government becomes the referee most of the times of the capital market. It becomes the regulator. So these are the big players in the capital market. What is traded? Equity, insurance, bonds, hybrid instruments, much more. What are the classification of capital markets? I'm just brushing this a little bit, then we'll stick to the strategy part of it. We have the primary market and the secondary market. The primary market is for initial offers. It's a first market. It can be public issue, it can be rights issue, it can be bonus issue, it can be private placement. Then we have the secondary market, which is for private placement or second, we may call second placement and so forth. These are explanations. I don't need to go much into this. IPO is whereby the firm first lists for trading to the public. What's called initial public offer. There's also what is called the public offer or further issue, still an offer to the public. Of course, just to stick with the IPO, it's one of the best financing techniques, not very highly taxing, because it banks on the future, it banks on dividend payout. Today, a firm is offered to the public. The public bring their money and buy shares for that firm. That's why it was initial public offer. That is the first time it is sold to the public. So members of the public from all walks of life can be brought in or are attracted to be able to buy. So what they do is they buy the shares, they give the money. The company uses the money to do its business. Then it pays dividends at the end of the trading period. Now, there are many theories that explain IPOs, but in general business, as a businessman, when you have a good investment that you think will bring you money, most investors will go to the bank, get money, do the business, enjoy the profits. But when they think that the future is not very good, then what do? They withdraw their capital from that investment by doing what? By offering it to the public. These are theories that you can study more and understand. So if you are to follow most of these theories, then it means it may not be good for people to buy IPO, literally. But it is good because you'll be paid dividends. In most cases, when the firm offers an IPO, the shares go down, in most cases. When most funds have reached the peak of the shares, and the management have seen that we may not go beyond this, then that's one of the reasons for IPO. Otherwise, if the firm has a good future, there's no businessman who will be willing to share future benefits with another businessman. Of course, that's the other side of the story. The other side of the story is that if a business sees a very good opportunity to invest in, and they don't have the money to invest in, they look for people who have the money, they bring the money, and then they share the profit. So now it depends what kind of an investor you are. Whether you are risk averse, you are risk sensitive, that's your decision to make. But that's what happens with an IPO. That's the initial public offer. So the initial public offer happens in a new market, or what you call the first market, whereby people borrow, then they expect payments in terms of dividends at the end of each trading period until maybe the ownership may be changed or whatever happens. This can be in terms of public offer for sale, private. I think you can read much of this. What are the features of a primary market? The command directly deals with the investors. That's why it's called an offer, public offer. You know, it's basically long term. Most of these are long term because when you are getting shares and dividends, you are expecting to get dividends for maybe the rest of your life or for the rest of the life of that farm and so forth. Then there is methods of raising capital. I think you've talked about public offer, private, government securities, all these are. Then secondary market, it also refers to market where the securities are traded after the offer. So it is called the secondary market. The primary market does the IPO, then the secondary market is the trading, you know. So it comprises of the equity market and the debt market and so forth. So I think you can study much of this on your own. So whereby the secondary market is whereby previously trading or previously issued securities. That's the thing. Now remember that the primary market is not in a physical location, but the secondary market is a physical location. The secondary market can be the stock exchange, which is placed in a place. The Addis Ababa Stock Exchange or the Athens Stock Exchange. In Kenya, we have the Nairobi Securities Exchange, right? But the IPO is placed all over the country. It can be even all over the world, depending on what is being offered and the legal basis for that. So the secondary purpose of the secondary market is to create liquidity in securities. People can buy and sell. If you bought under the IPO and you feel that you need to dispose of or move your investment there, then you do that in the secondary market. If you didn't buy in the IPO, then you can come to the secondary market and buy shares. Now, for the individual investors, the stock market is becoming an option, a good option for that matter, for individual investors. For example, now in many African countries, we are encouraging young people to invest in shares and stock. You know, we're trying to, you know, the idea that the stock and the shares are for the rich, the old people, you know, moving out of that. You can make $1 million in a day, the stock exchange. You can lose everything, the stock exchange, in a day. That's how volatile it is. But at the end of the day, depending on how we talk about the portfolio, how you put your portfolio. The scenario is that you buy lowly placed shares, hoping the prices will go up. Either you sell or you'll be earning shares, I mean dividends every year, depending on your objective. If today you bought 100 shares, each 10 bid or 10 shillings, that's 1,000. In a year, in 2 years, 3 years, the shares may be 500, one share. You become $1 million overnight. So, you know, that's why we said it's a market for raising shares, the capital for raising money, for raising funds. If you buy shares at 10 shillings and come and buy one share at 100 shillings, 200 shillings, 500 shillings, you make a lot of money. What is important is to be able to study the trends in the market and know when is the best time to make a decision. And that time is based on the information symmetry in that market. If you get the right information, maybe shares are going to be to go down, the company is going under, you can sell and run away. If the company is doing well, the shares are increasing, then you don't sell, you buy more and wait for the right time. So information symmetry, very, very important. Actually, the Capital Markets Authority operates because of information. Lack of information, little information, no information, and so forth. Features of the secondary market, it creates liquidity, of course. It has a particular place, I've talked about this. Prices are determined of demand and supply, of course. Very, very important, this one. It enables investors to adjust portfolios of their securities. So you're there using the information, making decisions. Your firm has invested in A, B, C, D. How is A performing? If it's not performing, you minimize. How is B performing? It's performing, you increase. So you'll be playing a game of portfolios to maximize your value. See where the value is coming from, invest in that. Where there is no value, minimize. Participants in the secondary market, you have the stock exchange, that's the market itself. You have clearing corporations that which assist. We have depositories. Depositories is where you keep the money, you keep the share. It's like a bank account. When you go open a bank account, when you open an account with the bank, they give you an account where you put them in the basket, the saving basket in this case. We have the trading members who are the stock brokers. We have clearing members. You can read much about all this. We have agents and so forth. What products? Equity, debentures, securities, bonds. You can read much about that. Issues in the stock market. We have equity rights issues, preference shares, debentures, bonds, and so forth. Then we have the depository. This is the bank where you deposit the money. Not the money, but the securities. And of course, this is done in electronic form. Nowadays, in most countries of the world, you can trade on your desktop, on your mobile phone. You don't need to go to the market. You can access brokers, you can access the market, you can buy directly, you can buy through brokers, directly through your mobile systems. I think in Africa, South Africa, Kenya, I think also Ethiopia, Nigeria, is now fully online. It's electronic. Other countries also coming in. What are the corporate action dividends? I think you can read much about it. Buybacks, rolling, you can read much about this. What is the role of the various participants? Depositories, you keep the shares. Stock exchange is the market. Right? Clearing corporation, these are the people who handle them, who handle the transaction, they're called the clearing. Then clearing members. These are the people who settle the deals. Then all this, you can read much about this, and derivatives, financial future, all this. What are the risks in the capital market? In every investment, there's also a risk. Long-term investments, long-term risk. The firm today may be doing well, but you don't know the future. So there's a lot of risk there, but also there's a lot of return. There's a lot of brokerage going on, so you have to be careful. These are also more risks. Behaves badly. Prices can be diverted. There is what we call insider trading. Insider trading. I think someone was talking about an insider trader. Now, insider trading in some countries is criminal. This whereby people in the system, people in the market, because they have some key information, either good or bad, they use that information to benefit themselves or to benefit some participants as they also benefit. For example, if you have information that a certain company is going to close down, and because it's going to close down, you may inform some investors that we are going to close down. Information that should not be released to the investor. The investors may go and sell all the stock, what is called dumping, awaiting the collapse. Because they will sell at a higher price. After 1 week, the company collapses. That means almost everybody loses. But the people who had that information, who use that information insider trading, they don't suffer. Some other times you are expecting the prices of the shares to go up, or you're expecting what is called share split. And then that information is leaked to some investors. So they go and buy more shares. If you buy more shares after the split, you'll have more shares. That's insider trading, which is bad. And so I said sometimes it is criminal. There are also issues of press releases and rumors and mass panic, especially when the company is going under. Sometimes even there is this or a change of directorship. It can cause panic in the stock market. And speculation is the key thing about the stock market, but speculation can be equally disastrous to the stock market. It can create what is called panic withdrawal or panic fleeing, whereby, you know, maybe there was a certain director who was doing business very well. Then now, rumors has it that this director will be removed, will be having another director. So people may panic. Maybe this director coming in may be from a certain firm, and people know, the investors know that person may not be a good person. So they start running away. That's what you find when it comes to change of leadership in organizations. In our last discussion, we'll be talking about strategic leadership. You find that your time is expiring during next year. A new CEO is appointed this year for smooth handover. You know, highly capitalized corporations, you don't just wake up in the morning and you say that we are sacking so-and-so, we are replacing with so-and-so, unless it's a radical issue. So you need to have smooth transition. If one leader is leaving, then that should be done within a certain period of time, unless it's an unavoidable exit, because, you know, some of the unavoidable exits that happen in organizations. But the best thing to avoid speculation. Speculation is very risky because people can withdraw their money overnight, or they can sell. And then when dumping starts, the prices of the shares goes down to the extent that it's a big loss to the organization. Efficiency of the capital markets can either be strong, semi-strong, or weak. And of course, this now depends on the market. If there's market asymmetry, if there's market symmetry, the best thing is whereby the capital market's efficiency is strong. Remember, the capital market is a market, just like another market. So forces of supply and demand are the best forces to propel the market. So if it is strong, it's a strong efficient, then that's okay. If it is weak efficient, it means there's a lot of lack of information or misrepresentation of information, and therefore it is not operating to its capacity. The best situation is to make it strong. Okay. What is the role of capital markets in corporate strategy? Explain the role of information asymmetry in the operation of the market. I can open this one for you, discussion for you. How does, maybe we can tackle the first one. Let me inform you. I think most of you are not aware. I'm informing you that we have a discussion, right? I'm informing you that we have a discussion. So what will be the role? What is the role of the capital? What role does it play? And we have had a discussion about all. What role does this play? Just maybe quickly, somebody who has not said something so far. But can we have somebody who has not said something so far? We need to have a change, you know. I'm not saying those who have been saying are not saying the right thing, but it's an open discussion. Anybody who has not what is the role? How does it affect? Remember, we said capital markets is where you get the money to run. So what's the relationship with corporate strategy? How is resources? You know, money is resources. The other time we talked about resources and value creation. How does resources, in this case money, affect strategy, corporate strategy? There we go. Somebody can save us, please. Samuel, your hand is up, yes.
Okay, thank you, Doctor. You know, you said it right. Like in any company, the main issues that keep pushing the company are the resources, and one of those resources would be the the capital resources. So in the capital market, especially, I take an example, a company. It's not a real company, but assume that my company needs a capital investment to run, to scale up, or to diverse, or to do any of those strategic decisions. So in that need, and when we need more capital, I think we go for capital, and one of those resources, sources of capital, is the capital market, where there are investors with their own money waiting for opportunities to invest in. So I think this is what I term as a capital market, where we can look. What would be the role is like, banks would be one of those sources of fund or sources of capital, but then the capital market also is the other, or maybe even a better option. So it would help the company boost up or even implement the strategy it's aspiring to implement. That would be the role, according to me.
Yes, that's very much okay. Another person who can explain to us? Another person, please. We're just winding up. We just want to hear from you. Yes, Shimil.
Thank you, Doctor. Actually, capital market, it is the main role of the corporate governance in their strategy, because no capital market means, after all, no existence for the corporate strategy. So this capital market, it provides for the financial industries and for the all organizations fixed and working liquidity, and for investment and for long-term and medium finance. So capital market is the main strategy for the corporate governance, because to do whatever the mission they have, whatever vision they do have, so it depends on their capital market.
Right. Yes, that's very true. Both discussion from Samuel and Shimiles, but also on top of that, Shimiles, there's something you talked about, corporate governance. Very, very important. The other time we discussed, I think last week, we discussed about corporate governance, right? Corporate governance practices. That's part of corporate strategy. The core of corporate strategy, corporate governance, because at the end of the day, if you cannot use the resources well, then what happens? It opens windows for mismanagement, misrepresentation. Now, especially if you borrowed the money from the capital markets, and then here comes a few people misuse that money. That means the organization cannot achieve its corporate destination. Now,
Sorry,
any
Doctor.
comments? Yeah, yes.
I'm sorry, I was trying to ask you, but I didn't get the chance. Regarding the moral hazard, this regarding our asymmetry information, both whether it is the first one is because if I am as a buyer, what should I do? Because the moral hazard, lack of information, it comes after the agreement. But for the first one, it might be my mistake, because I should try to gather information before I go to the agreement, or before I buy anything what I want. But for the moral hazard, as a buyer, what can I do? Because it's beyond my capacity. It comes after the agreement. So how could I minimize my risk?
You know, in life, there's something called morality, the word morality. And morality is, if you can, you know, there are some things that are moral, but they are not legal, if I put this direction. There are some things that are illegal and they are moral. Yet we also have some things that are immoral and illegal. right? So where is the distinction now? Just to understand the issue about morality, you know, people choose whether to be immoral or to be moral, right? It's your choice, you know, Shimeles, to choose whether you're going to conduct yourself in a moral way or in an immoral way. Now, people being human beings, they conduct themselves immorally, even when they know it is wrong, they are getting an extra benefit, right? Now, if you conduct yourself in the right way, that is the moral way, you are going to benefit. But if you believe that by conducting yourself in a way that is immoral, you are going to benefit more, then that is what brings immorality, right? Now, as a consumer, let's say you are an insurance agent, not an agent, but an insurance policy holder.
Maybe.
You bought insurance for your car or for your house. Now, ethical and moral standards dictate that you have to take care of yourself, right? Whether you are being paid for the insurance, for the policy, or you are not being paid, right? That is morality per se. That's morality per se. Now, it's like saying this. If I try now to move out of this. Now, in some countries, you find that there's free primary education. I don't know, in your country, do you have free primary education? Similar.
But you say
Free
free,
primary
what?
education. Free primary education. Do you have primary schools there?
Yeah, of course there.
Is it free in government schools or you pay?
There is a government school, some of the, no, of course there is free government schools, yeah.
Free government schools, exactly. Now,
Yeah.
if you take your child to a free primary school, the government will pay. You don't pay. Just this. But that does not stop you from parental responsibility. You're a parent. That one does not stop you from parental responsibility. If health care is free for the children, that does not stop you from being a responsible parent. And that's where moral hazard now comes in, right? If primary school is free, right? You take your child to a free primary school, then it means you must also take care of the child. If it is a day school, the child goes to school in the morning, comes back in the evening. So that means before the child leaves the house, he must take breakfast. That's your responsibility as a parent. The fact that the child takes lunch at school, paid by the government, does not mean you stop your parental responsibility. The child comes back in the evening, must take lunch, not lunch, but supper. That is parental responsibility, and that is morality, right? If there is free medical care for the children or even for yourself, that should not mean parental responsibility should cease. Now, one of the parental responsibilities, if you have in our country, we have malaria spread by mosquitoes. If the hospitals are free, or if you have a medical cover now, Shimeles, your company has a medical cover for you. You don't sleep without the mosquito net because you have a medical cover. You must be morally right to sleep under a treated mosquito net. Now, this is now the question of morality comes there, right? The fact that you have a medical cover for inpatient and outpatient 10 million shillings does not mean you don't take healthy food. You have to take healthy, balanced food. That's morality. So the fact that you've insured yourself does not mean you negate your own responsibilities. It is your life. What if the insurance company collapses? Where will you go? Who will pay your claim? Right? That's what it means, you know. Moral hazard is an aspect of personal responsibility gone wrong. That's why it's called an hazard. An hazard is something not interesting. We expect in a normal setup, if you insure yourself, then you also take good care of yourself. Because apart from the compensation, you're also more likely to live long, which is a benefit to you. Now, unless a case, where is Kinyanjui? Is Kinyanjui still in?
Yeah, I mean. Kinyanjui,
you're in. Unless whereby you go and take what you call personal life policy, right, for 100 million. And then Kinyanjui's wife realizes that Kinyanjui, the absence of Kinyanjui, the wife will be $100 million. You know, then he decides to do away with Kinyanjui, isn't it? So that he can be paid the money. Unless you are talking of that case, you know, which we don't expect to happen. Because we don't expect 100 million to replace Kinyanjui to the family. So it's a matter of principle. It's a matter of principle, and that's why it's called moral. It's you to know and to choose between doing the right thing or doing what you think is right. Right? Okay. Another question. I think time is moving up. Let me check whether there are chats here for any chats that are not being addressed. Okay, I think all of them are addressed. I agree. Yes. Okay. I think today you didn't chat much.
Doctor.
Yes.
Hello.
Yes. Yes.
Sorry, before we wind up, regarding, I have questions, or it is group questions for the first assignment. We are expected to submit. When is it coming week or when? The first assignment.
No, the end of the semester. We finish teaching, then we bring the assignments.
Both assignments, you mean? The first and the second?
Both. We do them at the end of the semester. Both. After we finish classwork, is when we go for the assignments. There is a course outline I sent to you that has dates. Dates, I think, look at it. Yes, look at it. It has dates and when this one should be done. You can even check where we are today, whether we are on course or we are not on course. I put some, just check. I put some time there, timelines. No, not the first one. The first one did not have that. But secondly, when I was sending you some materials, I put some timeline somewhere that shows where we were supposed to be. So I think another question before we wind up this class. You can see today no much chatting there, although we had a good discussion, which is also better than the chat. Any question before we wind up this class? Any question? Any question? Now we said those people who don't talk much in class, they will be will be doing some traditional dances. I hope you've not forgotten this. Those who don't say anything. You can't just come into my class the whole semester, just stay here, and then you go. No. You have to participate. So if you don't say anything, you don't contribute. The end of the semester, we'll Zoom you here, full screen, Zoom nearer, you dance to our tune. Right? Okay, take care. Bye.
Thank you, Doctor. Good night.
All right. Good night.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጉታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ አይሲኤም ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።